a whole lot of companies like Coal India, which is actually topping the list as far as advances are concerned. So Coal India is up around 3.7%, followed by Power Grid, which is up 2%. And then we have advances for Eicher Motors and LTI Mindtree. Both of these counters up by around 1.8%. On the losing end, what's really perhaps shedding some amount of weight, not as much, down 1%. Britannia, that's under pressure. Hindustan Unilever is also down 0.9%, as is the case for Asian Paints. That's down around 0.8% as well. So what we're seeing is that the consumption space is taking a beating. In fact, if you consider Titan as well, that's also down around 0.6%. So in the consumption space, it is essentially a handful of these names which is weighing down on the Nifty 50. Now, moving on to the broader markets, and that's where things have changed dramatically, and in fact there's been a substantial outperformance. I was actually looking at the returns of the Nifty Small Cap Index on a financial year-to-date basis, and well, it's up as much as 15% already, and we're just about 2.5 months in. In this financial year to date, it's already advanced by around 15%. If you consider the mid-cap index and the returns on a financial year to date basis, that is also up 14%. So it's clear that the broader markets are showing a lot of strength. It is, and the outperformance with respect to the benchmark continues there. And I'm sure that all those investors who bought ETFs of the respective mid-cap and small-cap indices, at least at the moment, are laughing away all the way to the bank. Now, this is, your overall picture. Coming down to how things are faring in the broader markets in today's day of trade, let's pull up a handful of names and see where there is traction. So we have names like Elecon Engineering, which is up as much as 10%. Tata Tele advancing by 6.4%. Max Health advancing by 6.3%, MMTC up around 5.6%. So a lot of counters out there doing very well in trade and also keeping the broader markets higher. In fact, if you on the NSE 500 or the Nifty 500, you have about 350 stocks which are advancing as against 150 stocks which are on the decline, which means that we have yet another day of trade where we are looking at a good traction towards the positive end. That's your overall NSE advance decline ratio, about 1,600 advances for about 500 declines. So that's a 3:1. Let's get in our expert for today then. We have Ashish Maheshwari, Director at Arihant Capital Markets, who's joining us on the show. Ashish, good afternoon. Thank you so much for joining in. Before I come to you, I'm going to get in our first topic for the day, and that's TVS Supply Chain. We have Kanika who's joining us to tell us about the latest updates as to why we have seen an advance in the stock. Kanika.
Right, so TVS Supply Chain Solutions is in focus today, and the company has received a 5-year contract with Daimler Truck AG, which is the world's largest manufacturer of commercial vehicles. Now, this contract is for integrated supply chain solutions service in Singapore, and the contract solidifies TVS SCS as primary logistics partner for Daimler Truck AG. And few key operational goals of the deal are firstly to develop robust logistics solution for spare parts distribution, and also to streamline supply chain solutions, supply chain operations for 16 Asia-Pacific countries from a Singapore logistics center. Now, the stock is buzzing in trade today with an intraday high of almost 7.9% and volumes trading over 8.8 times its 30-day average. Now, coming to its management outlook, the integrated supply chain solutions business momentum is expected to continue in FY25 as per the management, which will be supported by a healthy pipeline and continued focus on margins. Additionally, the integrated final mile business, that business will achieve target run rate profitability by Q2 of FY25, and the global forwarding solutions business freight rates have normalized, and FY25 focus will be on improving profitability. The company also expects revenue growth of 15% year on year, and the capex guidance remains unchanged at 1 to 1.5% of revenue in the medium term. Back to you.
Okay, Kanika, thank you so much for getting us those updates. Ashish, welcome to the show. Not sure if TVS Supply Solutions is on your radar, but your view on this one, if it is, and otherwise on the logistics sector going ahead.
See, this is again a stock which people have just forgotten. If you see from the time of their IPO came, IPO got very moderate kind of response in from this group of TVS. Just all it got only 2.8 times oversubscription, and IPO price was 197. So this is a stock which has not delivered at all any returns to investors, and we have seen continuous selling from FIIs and DIIs also in this stock. Again, we have seen even last quarterly numbers were quite muted. There was decline in profitability over quarter, and year over year also, top line is not growing up. So, in my view, this news is positive, but I'm afraid this stock will have a lot of selling pressure when it reaches its IPO price. So, I'm neutral on this news as such.
Okay, well, neutral as far as this update goes. Let's move on and talk about Tata Motors, and we have more updates now here. Want to once again get in my colleague Puneet to tell us about what's more which is in store. And this time, Puneet, I believe we have brokerages.
Yeah, that's right. So brokerages have come out with positive commentary in general for Tata Motors post their investor day held yesterday. Now, we've divided what the most brokerages said in what the key segments that the company operates in. Now, for passenger vehicles, they have said that, that market share for the company has gone up from just 5% back in FY20 all the way up to 14% now to become the number 3 player. Now, the company is expecting to increase this to roughly 18 to 20% by financial year 2030. And they are also looking to have 2x launches based on the PV industry to fill any kind of products gaps that they have currently. This will also increase the addressable markets to roughly 80% from just 53% currently. And this will start with this year with the launch of the Curve as well as the Harrier EV. And next year, brokerages have said that the Sierra as well as the Avanya, which is the new platform for the company, will be coming into launch for the next financial year of 2026. For commercial vehicles, the commentary has been that the CV industries has absorbed various past disturbances, and growth outlook is looking upwards from here. Company also is expecting roughly 4 to 5% growth in volumes for the industry over the next 5 years. That's what they have said. Nuvama feels that the CV volumes shall witness some slight moderation this year, but FY26 looks like a good year for the company as well as the industry, and EBITDA margins will stay in the double digits, and the company is expected to increase it to mid-teens from the current 11%. On EVs, this is a very interesting space. MK has said that by 2030, Tata Motors will have roughly 30% of the sales coming from the EV sector itself. And they are targeting profitability improvement for the current year, which means that by FY26, they will have an EBITDA break even for the EV company itself. And finally, any kind of future guidance, they have said that they are looking to launch more products in the EV as well as the passenger vehicle space, and the share of CNG as well as electric vehicles in total will go up to 45% from 29% currently. Do know that these are high margin businesses, so will be very well for the company. Just finally getting in the targets, now MK has upgraded the stock to an add from reduce earlier. They have a target price of roughly 1,050 rupees, which is a 8% upside. Jefferies has maintained a buy with a target price of 1,250 rupees, which is a 28% upside from current levels. And finally, Morgan Stanley with a target price of 1,100, which is an 11% upside from the current level. So overall, positive commentary on the investor day itself for Tata Motors. Back to you.
All right, Puneet, thank you so much for getting us those updates there as far as Tata Motors is concerned. Ashish, how are you assessing Tata Motors?
Yeah, from a high of almost 1,070, we have seen a big correction up to 920 in Tata Motors. And again, stock is getting a lot of accumulation. And again, as investor day insights, if you follow, one good thing is that in 2025, they'll be net debt free in company as such. So you can imagine kind of cash flows now company is generating. And their EV vehicles are getting a lot of traction. We have seen Nexon doing really very good sales volume, and the kind of waiting is there now for Tata Motors EV vehicles. This company will continue to do well. And in my view, this is again stock where we have seen a good set of quarterly numbers too in last quarter. So I'm quite bullish as far as Tata Motors is concerned, and I'm in sync with other brokerages which have given even target up to 1250 in Tata Motors. And in my view, these are quite achievable. And passenger vehicle and EV are going to be again growth driver for Tata Motors.
Okay. Time for a short break, and on the other side, we get you the balance of those stocks. Ashish, stay with us. We'll be back in just a bit. Okay, welcome back to Hot Money, and we are now taking stock of the cement space. This very morning, we've had a broking house suggest that there could be further upside here on the back of various many reasons. Going to get in my colleague Harsh to tell us more about this one. Harsh.
Well, yes, Agam, such a strong focus with regard to infra over the last couple of days that can't help but not ignore cement, and a couple of very interesting notes coming through. You have Motilal, whose channel checks seem to indicate an 8 to 10 rupee hike per bag in terms of pricing of cement, which is likely a key positive given that April volumes for cement were muted. May volumes are expected to pick up a little bit. That's the other hope and expectation. 4 to 5% growth month over month expected in May as well. So some uptick in pricing, some uptick in volumes as well, which is a positive. Now, in terms of the domestic petcoke prices as well, Motilal seems to suggest that prices have declined 6% month on month, should further aid the cement industry. And this is a secular kind of a trend that's playing out as per Motilal. So it's across regions. That's the other key piece. Now, they're expecting demand momentum to improve even further from here. And their preferred picks being Ultratech within the large cap space, JK Cement and Dalmia Bharat within the mid cap space. Now, sticking with Ultratech, because Citi's top pick is also Ultratech, and Citi has also come out with a note on cement. They believe that, Ultratech is their top pick in the space. They are expecting 146 MT of clinker backed incremental capacity to be added between FY23 and 27. Again, they believe that ACC, Ambuja, Ultratech and Shree and Dalmia will account for 75% of this incremental supply. They believe that the trend of market share priority over pricing will continue, which has been the case there, but slightly different from the Motilal view. They are expecting realizations in the range of -4 to +1 in Q1 FY25 versus Q4 FY24. So pricing is probably where there's a bit of a differential in terms of view. They're expecting the cement pricing trajectory to largely remain. So a couple of very interesting views on the cement space coming through.
Right, absolutely. Harsh, thank you so much for that. Ashish, what's your take on the cement sector, one, and even in the sector, what are the names that you like at the moment?
See, in spite of whatever we say, that the demand was not there or sluggish growth was there in previous quarter, if you take example of even Ultratech from 16,700 crore, they did almost 20,400 crore revenue from December to March quarter. So momentum will continue, and this affordable housing new projects. What government is now talking of 3 crore new houses will be built in coming years. So this is again a shot in the arm for these companies, along with, as we know, that because of election code of conduct, not many mega projects and infrastructure were awarded. So now all those awards will start coming in this quarter itself. So I'm quite gung-ho as far as cement sector is concerned, and my best pick remain Ultratech, followed by India Cement, which represent southern part of country cement player.
All right, Ashish, well, hold on. And, well, the final theme that we wanted to address was the FMCG sector. We've had earnings come in, and it does seem like while the earnings were subdued for the quarter gone by, there was suggestion from many managements that there's been green shoots in the rural area. And remember, rural demand specifically has been the big challenge over the past couple of years for the entire sector. That's one thing. The second thing, of course, is that because it is staples, the valuations continue to remain very rich, even considering the kind of subdued growth that the companies have seen of late. Now, that said, going forward, we do have a little bit of weakness as far as some of your names are concerned today. So we have Marico down 2.7% today. Britannia, Hindustan Unilever, Godrej Consumer Products, all of them are looking at cuts of around 1%. And after that initial up move, post the earnings coming through, we've once again starting to see a consolidation in the FMCG sector. The question really is, at the moment, is there a genuine opportunity? One. And the second one is that if there is a genuine opportunity, will valuations still, support this up move in the FMCG sector? Ashish, these two questions for you, your overall view on how this space would turn out.
Even if we see Nifty FMCG index also from 50,000 low, which it made in this year, it has already moved to 57,580, which is coming on the screen, and it is just down by almost 1,000 points from its 52-week high. So this is again a sector which has really performed in last few months. Even last 1 month, it went up by 4% odd. I agree with you that some slowdown was envisaged in their revenue growth in the previous quarter. But if we see in the last quarterly numbers of even companies like Dabur, Varun Beverages, Marico, Colgate, they are not showing any slowdown as such. And all these companies have given returns or results better than expectations. So I'm not that bearish as far as this sector is concerned, though today's slightly down because again market is chasing risky themes. But this is a sector which will continue to grow. And as soon as monsoon reaches in a major part of the country, again I'm expecting sales volume will go up and these companies will start again faring well. So my thumbs up for this sector as such.
All right, there you have it. That's a view on the FMCG sector. Well, on that note, taking a moment to thank you, Ashish, for joining us and taking us through your views on the several stocks and sectors that we wanted to address. And on that note, we wrap on this edition. But before that, Union Minister Hardeep Singh Puri said India will target a 20% ethanol blending by 2025, which served as a factor for the uptick in sugar stocks yesterday. My colleague Mathew caught up with ISMA's Deepak Balani on the government's policies for the sugar industry. Listen in.
I think we believe that the government, first of all, will continue the proactive policies for the sugar industry. As far as our expectations are concerned, I think with Modi 3.0, the government 3.0, immediate actions of the government should be for the long-term stability of the industry. You know that the government made a policy shift in December 23 and reduced the juice and B-heavy based ethanol production. So it was reduced to 17 lakh tons diversion in 23-24 from 38 lakh tons the previous year. So this curtailed the juice and B-heavy production, which resulted in the underutilization of the installed capacity, which we all know led to huge losses to the industry. I think this has resulted in a substantial increase in sugar inventory which would be, I think would be around 90 lakh tons on 1st of October this year. So therefore, I think first of all, these policies should be re-implemented to manage the rising sugar inventories and also support the industry's stability. So I believe the first and the foremost priority of the government should be on continuation of the ethanol blending program by allowing juice and B-heavy for the ethanol production. Second, but equal priority is also the revision of MSP of sugar and its alignment with the FRP of sugarcane. In earlier years, depending on the FRP, MSP was raised to ensure viability of the millers to pay the cane prices to the farmers in a timely manner. So it was always that whenever there was an increase in FRP, government increased the MSP. But since 2018 and 19, they have not increased the MSP. So I think that needs to be corrected, and the MSP needs to be revised vis-a-vis the increased FRP of sugarcane. Third is a very important factor, that the revision of ethanol pricing. Any time when the FRP of sugarcane was increased, B-heavy, C-heavy and juice-based ethanol prices were corrected accordingly. I think we would request government and we expect them to correct the ethanol prices for the juice and B-heavy for 23-24 and for juice, B-heavy and C-heavy for 24-25 in line with the increase in FRP of sugarcane. As far as the 20% ethanol blending target, I think we must congratulate the government. I think we are on the right track. As ISMA, I think we are very confident that the ethanol program is on track. Going forward, things look good and the sugar sector will achieve its target. I think currently we have our capacity specifically in the sugar sector of around 850 crore litre. And as per the Niti Aayog report, requirement of 20% blending will require approximately 1,000 crore litre of ethanol. So I think they have projected, Niti Aayog as per the their roadmap, they had projected a requirement from sugar industry to be around 550 crore litre. So I think we believe that with sufficient feedstock availability, we as a sugar industry will be able to cater to the required quantity as per targets. So for this, we basically have also submitted an action plan to the government for long-term sustainability of sugarcane production, which will help negate fluctuation in production we have seen because of the uncertainties of weather. So we are confident that the sugar industry will be able to supply almost 55% of the total ethanol for 20% blending. And I believe the government is very keen to work on our proposal, and we hope that they will come out with a national mission on sugarcane in near future.
That's really great. My another query on this is that there is, on one hand, where so much of thrust is there on meeting the ethanol blending target. On the other hand, ISMA is also seeking the government approval for 2 million ton of sugar exports in the marketing year. So how is it likely now with the change in the government is saying, but definitely with not as clear majority. What do you think? Is it likely for the government to approve this?
See, we had already requested for an approval of 2 million tons of sugar exports, and that was based on facts and figures. So if we go back in the last season, the opening stock, for example, in this 23-24, the opening stock was around 55.65 lakh tons. And we had the production of 320 lakh tons this year. And with domestic consumption of around 285 lakh tons, I think on 30th of September this year, we will have a closing stock of around 90 lakh tons. I think we believe that we have enough supplies to meet the domestic demand of sugar and also export at least 2 million tons of sugar this year. And given that the fact that we have an improved pre-monsoon rainfall, we have the forecast indicating above normal monsoon conditions, and the sugar production for the 24-25 is expected to be moderate. I think it will ultimately, we will have a substantially higher closing stock going forward. So I believe this export allowance would not only ensure a comfortable stock for domestic consumption and also sustain the ethanol blending program, I believe it will also contribute to maintaining the financial liquidity of sugar mills and enabling them to pay timely payments to the farmers. I think with these, we expect the government to take a decision on export soon.
Thanks for tuning into the Portfolio Manager. I'm your host, Neeraj Shah, and our guest today is Bhaven Shah. Samiksha Capital joins us right now to try and understand if the portfolio strategy that an investor should be different in the next 5 years versus to what it has been in the previous 5, previous 10, or even maybe during the 2003 to 2008 period, which a lot of people equate. with what is happening in India currently as well. Bhavin, great having you. Thanks for taking the time out. How are you assessing what your portfolio strategy should be in the current context relative to what it may have been in the past 5 years, or is generally the investing style?
I think one thing that we obviously went through a lot of questions and the whole kind of drama over last week or so as to how the new government would look like. I think that is now some clarity is emerging, and so I think there would have to be a constant search for the companies that are going to benefit from the focus of this government on driving economic growth through investment in productive capacity. And I think to some extent we continue to be somewhat underinvested in that space, and so we would want to keep doing our search to see how we can add. But obviously we have our own constraints in terms of how we decide where to invest in, and in many cases a lot of such stocks have the valuations are quite rich. Interestingly, I think the over the last few months, what I've observed is that a few pockets of opportunities in smaller cap and also in financials have either opened up or have remained attractive, and so we can also evaluate that and maybe participate indirectly in the likely period of strong economic growth. So what I'm saying is that our core strategy of investing in bottom-up ideas which are available at valuation from which we can generate superior risk-adjusted return, that doesn't change. And I think so we keep trying to find such opportunities.
Where is value, in the current context with the markets being where they are, or even the broader end of the spectrum being where it is?
So, I think if you run the screens after the Q4 results, there are companies that do come up, trading at say 4 or 5% free cash flow yield, and obviously not too many, and obviously kind of splinter across different sectors. It's not like any one sector we can say here is. There are sectors like maybe some of the automobile related, tires and so on, which might be more attractive, but then obviously there are cyclical components one has to take a call on. So I would not say that it is across the board, but a few companies here and there, especially those who reported strong, results, and market is maybe in there is whole focus on election and other aspects, maybe haven't really latched on to such companies. So I would say there are names across many sectors, I would say.
Okay.
But these are like not big cap, easy to identify names. Yeah.
Okay, so is your portfolio tilt towards the small cap end of the spectrum, Bhavin, part one? And part two are some of these companies that you're talking about, for example, because I'm guessing that since you're a bottom-up investor, I'll come to the policy conversation, but just trying to get the valuation conversation out of the way. Are the companies which are available those which have underperformed financially in the recent past, say for example chemicals, because it's a sector that has not done really well per se in terms of quarterly results for the last 2 or 3 years now. So is it some underperformers which are giving that valuation, or are growth companies as well available at cheaper valuations?
Well, I think if you look at financials, there are growth companies which are available at cheaper valuations. So there are, I think, so in that particular sector, it is not, the underperformance is not because of, the share price underperformance is not because of business underperformance. It's just that market has not, I think maybe there are some concerns that are lingering about the outlook in some people's minds. You can also, and within financials, you can look at banks, you can look at NBFCs, even insurance. There are opportunities in multiple spaces within that. where the business performance is good, but the share price is not fully reflecting that. And I think outside of that, since I'm talking about company-specific situations, I think it is more of the case that it's just that market has not latched on to some small cap opportunities. And as far as our portfolio tilt, yes, it is tilted a bit towards small cap. However, we do have some risk management criteria, so we have to have some exposure in liquid, larger names. And I think I think that tilt towards small cap is not any higher than it has been for some time. And in fact, it is also below the maximum exposure we would have had in small cap over the last 8 years.
Got it. Bhavin, the question therefore is, what's the mix currently in the portfolio? Is it, are you mirroring the index in particular way? I would love to understand whether the portfolio has any presence of information technology in particular, because you are a very old hand at that pocket. You've seen those businesses for a number of years. What's the portfolio tilt? And specifically on banks and IT, which are two large weightages on the index as well, where are you relative to the indices?
So I think we are, first of all, I actually do not pay a huge attention to the portfolio tilt in the sense that I don't really look at sector by sector how we are overweight, underweight. Perhaps we should a little bit more. And I think, interaction like this kind of forces us to think in that direction. So, we would certainly go and do that. And I think what we notice is that, within financials, where we might be overweight is the wealth management space, wealth management and broking space. We are overweight there. I think our view is that it's a very underpenetrated sector, and there are some excellent businesses available at reasonable value compared to their growth, and that's why we are overweight there. We are also overweight healthcare related to index. And what I have observed is that there are a number of companies in the healthcare space that have delivered very strong performance. And I think they will continue to deliver strong performance, bearing any unexpected unnecessary regulatory intervention. And I think, with that, with that kind of prospects, we would like to continue to have that overweight stance. I think on the other hand, we would be underweight something like, say, crude oil. We are also underweight power, not because we don't like the sector, but we think that, we have kind of perhaps missed that opportunity. I think power is going to be power demand will continue to grow rapidly. One, because of our economic growth, but two, also because of, some of these trends related to Gen AI, which is power consuming and so on. We are overweight aviation. I think that's the one sector where obviously there's not too many companies, but the companies that are there, I think one of them obviously offers an excellent investment choice and has been in part of our portfolio for quite some time. I think coming to IT, we are underweight IT actually. So I think if you look at the IT sector pre-COVID, we will recall that the growth rates were coming down for the IT companies, and the discussion was around whether it's a mid-single-digit growth going forward, slightly more than high single-digit growth, and that was the discussion. And then came COVID, and suddenly there was a growth spurt. And I think we are now again entering a phase where the growth is normalizing back to post-COVID levels, which might be more similar to the pre-COVID levels. And then there is this whole disruption led by machine learning, Gen AI, and it is, at the very minimum, it is causing the companies or the customers to shift their priorities. And as a result, I think the growth opportunity for the large cap IT companies is looking a little muted. And in that environment, we don't find any great value in the large cap IT. We would have some pockets of opportunities in some of the smaller IT companies, but just owning them, is not going to lead us to even a market neutral, sector neutral stance on IT, because we restrict our position sizes on a smaller cap companies, to avoid any significant impact cost at the time of exit or for the even at the time of entry.
Okay, Bhavin, just last couple of questions. I'm just trying to understand. Can ER&D, for example, do slightly different than what mainstream IT does? And do you foresee a possibility of AI-led developments leading to a reduction of workforce in the IT industry over the course of the next 5 years or longer?
I think so. ER&D definitely has a stronger growth potential than overall IT sector, although ER&D is not new to India, I think I saw the activity even back in late 90s in that sector in India, and I think now it has obviously expanded a lot more, and this global capability centers of of the top tech companies in India obviously further creating a stronger ecosystem. And so I think, ER&D will remain, will continue to have higher growth opportunity compared to overall IT. And as far as what AI does to the overall demand for IT services, I think the question is obviously somewhat, we can say, let's see. But my feeling is that AI will perhaps enable programmers to do their job more efficiently. And actually, to be honest, as the feedback I receive from programmers today is that the help that AI provides, the co-pilots that are available, is not very kind of significant. The kind of things that the code that generates, can have, still have a lot of flaws in it and so on and so forth. But let's assume that, this will continue to improve. So yes, the programmers will be able to write sort of code in a shorter period of time, but I don't think they will be replaced. And I think what will happen is, they will undertake more complex tasks. There will be more automation. In my small company, I definitely observe that, by using Copilot for software development, maybe we are able to automate more things than we would have earlier, because the time it takes to do it is shorter. And I think as we do that, we come up with some new ideas. How about this? And what if we come up with some automated script to do it this way? So I think as long as the semiconductor Moore's law prevails, I think the humans will find ways to kind of tap into that potential and come up with more interesting solutions or more complex solutions. So I don't see sort of AI being sort of that way and a big negative for the demand for programmers in the long run.
Got it. Okay, great. Bhavin, always a pleasure talking to you. Today was no different. Thanks for being with us, and look forward to talk to you more often.
Yes, thank you, Neeraj.
All right, and that's the view on this leg of Portfolio Manager. Thanks so much for tuning in, and stay tuned to NDTV Profit for more news and updates.
welcome to NDTV Profit. You're watching this special interaction. The new government has come into place, and all the ministers are back in charge of various ministries. And within the power ministry, we have policy continuity also coming in, because the key focus remains for this government is to increase power generation and power transmission going forward. And joining me today is Harsh Shah, who is the CEO of IndiGrid. Harsh, thank you very much for joining us on NDTV Profit.
Yeah, thank you and good morning. We certainly believe that there is a need to be pushing more projects on transmission side, on battery storage side for the country. And let's zoom out a little bit and consider why we need energy transition. For us as Indians, energy transition is not just about economics, it's also about geopolitics. It allows us to reduce our dependence on oil, and therefore, supports us on geopolitics as well as on financial matters, because then our forex reserves would increase. If at all we are able to harness the power of the sun and wind and the water completely. So that is the need and the urgency for the country. We have goals for 2030, 2047, different goals, but the underlying need is that how do we as Indians become independent for energy, especially when we are blessed abundantly with the renewable energy sources. Transmission and battery storage plays a crucial link to enable power to flow from where it is best produced by renewable energy, where it is solar or wind or hydro, and how do we make it reach the consumer. Our entire historical development on power transmission side over the last 7 decades, out of that 6 decades, has only happened towards thermal plants. And therefore, the energy highways are shifting towards renewable energy to consumer. And that's not just happening in India, it's happening across the world. And therefore, we do believe that there is a need for further expediting the investments in transmission and battery storage space.
Harsh, there's an estimate by rating agency that nearly $190 to $215 billion of investments would be required in power generation, to meet that 500 gigawatt target that we have set out for 2030. A large portion of that is dependent on green energy, which you clearly mentioned, solar, wind being some of them. But equally, it also mentions that the grid network would need an investment of nearly $150 to $170 billion as well, so that the power which is getting generated can be brought to the grid or to the national grid and distributed. How do you see investments now taking shape in the transmission sector?
I think, as you rightly mentioned, there is a goal, there is a need for investment in transmission space. Now, everything after that depends on how we as a country execute, starting from policy to enabling policy to financial policy and thereby. Till now, the previous government had done a phenomenal job in terms of launching variety of schemes for the benefit of more projects coming up. And let me tell you, over the last 12 to 15 years, since the private sector participation on the transmission space has happened, and even if we stretch from 2000s where the transmission investment really picked up pace, right now we are looking at an unprecedented pipeline of about 150 lakh crores of projects in the market, which was pretty much equivalent to what got built over the last 10 to 15 years. So we are looking at an unprecedented pipeline for investment opportunity for investors. So we do see that more and more investment will come and more capex will happen in the sector.
Which are the geographies where you see maximum capex coming up? Because we understand that there are some of the geographies, especially linked to solar and wind, where there is a congestion in the network. Will that be the first one to see major investments and followed by fresh, capex coming in to set up new capacities?
Certainly, I think it's just not about solar, right? You need to reach the demand centers as well. But to answer your question, a large amount of investment on transmission is happening on the western part of the country, where the sun and the geography is apt for solar generation. But that's not about it. There is also Ladakh that is getting evaluated for mega solar power projects, and that will also make investment in the northern sector. Also on the northeast, there is not just demand growing, but also the hydro potential is massive in the northeast. And the south, or I would say southwest and the east part, where there is a lot of wind potential. In addition to that, now we are talking about the offshore wind. So I don't think that the transmission is geographical focus, because we have wind on wind and solar on the west of the country, wind on the southern country, east is filled with hydro, and the north is again solar. So we do see it as scattered across the country.
Okay, give me a sense of the kind of projects which are pending for tenders. Means in the sense there would be a tender processed for these transmission projects. What is the quantum of that coming up?
So right now approximately 140,000 crores of projects are approved by National Committee of Transmission for tender, and I'm only talking about the central projects. Right? I'm not talking about the state transports right now. That itself is around already announced identified projects of about 140,000 crores.
And the tendering should happen in the next couple of months?
Oh, no. It takes around 12 to 18 month cycle. So it's not for 2 months. It's an 18-month cycle for all these projects will come into life.
So in the next 12 to 18 months, all these 140,000 crores worth of projects would be tendered out to players like you and others who are into the transmission and distribution business.
Yes, that's the expectation.
One of the biggest challenges that that you as a sector also look at is low cost and long-term capital. How do you look at this thing? Because these are huge investments, and this require and long tenure investments. So, how are you looking at this entire capital raise, which is required to manage this kind of projects?
I think we are one of the most successful in the largest energy transition InvIT in the country. So I would say we have attracted top-notch long-term capital in our business. Having said so, we are a very small player in the scheme of the things. We have just about 30,000 crores in size, and there are other players who are 2 times or 10 times bigger than us. So I think we have a very good mix in the transmission space, starting from Power Grid, who is state-owned, to completely financial investors owned like IndiGrid, to promoter-owned entities. So we have a very good diversified pool of capital as a country to take this risk on and really execute these projects. Having said so, I think eventually the cost of capital of projects is dependent on the risk premium of the country. And that is what decides the cost of debt, cost of equity, and variety of other factors. And I think that's, as a country, we are moving in the right direction. And hopefully that will reduce the cost of capital for all of us together.
So what are the policy initiatives that is required from the sector or from the industry, from as far as government is concerned, so that things become smoother for you for not only bidding but also execution, because execution is a big challenge, and many of the companies get stuck because of the capital financing requirements which are there. So what kind of policy initiatives would be required for this sector?
So I think like any other infrastructure sector, the initiatives are similar to support the infrastructure financing. On the execution front, yes, there are a lot of initiatives that the past government and the teams have taken. We just expect that continues, because it is still one of the difficult projects to execute, because it is cross-country. There are issues of right of way, there are issues of forest clearances, variety of things that come in place. However, I would say that the government machinery over the last 10 years have worked incessantly to remove these issues, whether it is interministerial, center state, or variety of things.
And how is IndiGrid placed in this entire sector, not only just to grab the opportunities, but also from a capital point of view? Do you have enough dry powder around so that you can come and bid for the projects and invest in this project for the long term?
Well, certainly. I think we have enough dry powder, and we have built sizable credibility over the last decade to ensure that we have the right set of investors supporting us and growing the portfolio.
And what is the kind of target that you have set out maybe in next few years? What is the kind of capacity addition that you're looking at?
So we don't really look at in terms of crores target. We already have a sizable pipeline with us. For example, for battery storage, we already have around 500 megawatt hour of projects. We'll look to increase that to a gigawatt or 2 gigawatt hour of projects. On the transmission space, portfolio is approximately 24,000 crores. We look to grow it another 20-25% year on year.
And do you think that when you speak about battery storage, there are enough technologies available now and cost effective as well?
Oh yes, there is sufficient technology available, sufficient proof of concept, as well as the cost have become at grid parity level, and we will see more and more action on this space because the costs are meeting the thresholds that as a country we could pay, and the technology is very mature, especially lithium ion has been implemented at gigawatt scale across the world. And we are pretty confident of the technology being successful in India. I'm sure there are emerging technologies like sodium or others which will come into place. But lithium ion has been there for almost 2 decades, and we are confident that it will continue to thrive.
Harsh, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Thank you.
and welcome. You're watching Market IQ on NDTV Profit. I'm your host, Smriti Chaudhary. Let's take a quick look at the markets. You have the Nifty 50 holding trading very close to 23,500, up about 0.6% right now off the high point of the day. Let's look at the breadth of the market as well to understand what's currently happening. So there's a little bit of pressure that has built in now. We had about 1,500 stocks in the morning gaining. Now that has come down slightly and a little bit towards the declines. That's pretty much what's happening on the benchmarks. Among the sectors, if you look, you have the realty and FMCG dragging today. Realty down about 0.5% and FMCG as well. However, PSE Media, Energy, PSU banks doing very well in trade today. Let's also pull up the contributors of the Nifty 50 and see what's pulling the index higher. You have something like an RIL, HDFC Bank, Bharti contributing about 50 points or so to the index. You have HUL, Titan, Britannia and M&M dragging on the other end. Let's look at some of the counters that are moving as well. You have Ward Wizard Innovations that's down about 7% in trade. Now this comes on the back of some promoters selling some stake. Now if you look at yesterday, they came out with an exchange filing saying that they have received an order which in fact is an MOU that they have signed, and once the price rose after that announcement, it seems like promoter has sold stake. No allegations here, but just putting it out there, the two pieces of news. Then you have something like a TVS Supply as well that's gaining about 5% in trade. This comes on the back of a 5-year contract that they have signed with Daimler Truck AG for integrated supply chain solution services in Singapore, and you're seeing the stock holding those gains above 5%. But of course, the talking point of the day is there's recognition by the World Bank that India will continue to be the fastest growing economy in the world this year, but its projections are lower than those set out by the Reserve Bank of India just this week. The World Bank forecasts India's GDP will grow by 6.6% in FY25. It said this in its Global Economic Prospects report for June. For FY26 and 27, growth is projected at 6.7% and 6.8% respectively. After a high growth rate in FY24, this moderation is mainly due to slowdown in investments from a higher base. However, investment growth is expected to remain stronger than previously expected over the forecast period, aided by public and private investments. And to put all of this into perspective, I am joined by Dheeraj Nim, economist and forex strategist at ANZ Research. Thank you so much, Mr. Dheeraj, for joining in. It's a pleasure to have you on the show today.
Thank you. Thank you for inviting me.
Well, let me start off with the growth numbers that we saw for India for FY24. It surprised pretty much all the economists around. Do you see these numbers kind of holding on in FY25 as well? What's your expectation?
No, so I think the growth numbers of the order of 8% or higher are certainly behind us. My own expectation is that for fiscal year ending March 2025, growth would be somewhere around 6.8%. This is broadly in the range of 6.5% to 7% that the market is expecting. Of course, the Reserve Bank of India is slightly more optimistic now at 7.2%.
Right. Let's also talk about the GVA numbers. While the GDP came out very strong, you look at the GVA growth at 6.3% for FY24, which is still a little lagging, you know. So when do you see these kind of similar trends come across in that as well?
Look, I think in the GVA growth, there is, of course, a clear trend of a modest slowdown, which was largely along the expectations. But it would be erroneous to compare the GDP growth trends with the GVA growth trends. Now, if you drill down into the details, a large gap between GDP growth and GVA growth, by my analysis, is a reflection of fiscal consolidation that has been happening at a decent pace in our economy. Subsidies have been falling, especially by the center, and indirect taxes have certainly surprised on the upside, especially on the non-GST accounts. So I do think that the gap was perhaps explained by a shift from fiscal expansion to fiscal consolidation. However, having said that, I do think both GDP and GVA growth rates for the quarters to come are modestly switching to a lower gear.
Point. Let's also talk about inflation numbers. RBI has put stress on food inflation, and this was not the first time in their commentary that this has come up, and this has been going on for a while. Now the question remains that this time, however, the monsoon expectations are well above normal. Do you think that's going to kind of change things, and what's your inflation expectation keeping that in mind?
Well, I think a good monsoon is an imperative at this moment for us to bring down our food inflation and for the Reserve Bank of India to eventually dial down their hawkishness. Mind you, at the beginning of this cropping season, we also have reservoir levels which are not very encouraging. So a good monsoon is really required at this moment for the sake of lower food inflation. Now, my own projection for the whole of FY25 is 4.3%, slightly lower than the RBI's 4.5%. I do acknowledge, however, that the RBI's forecast, which looked a bit conservative before, are actually panning out as per the plan. So I think inflation could certainly land in the range of 4.3 to 4.5% for fiscal year 2025. And as far as the print that is due later this evening is concerned, I do think inflation may have accelerated a bit to about 5% from 4.8% in April, largely on the back of higher food inflation, especially as vegetable prices, pulses, and cereals inflation remain quite, accelerating.
All right. Also, let's talk about core inflation as well. That's below 4%, and that's been the trend as well. Why is there this gap between the headline number and the core inflation number? If you can put that into perspective as well.
Well, you're right in pointing out core inflation is actually quite weak. And I think in today's print, we could see it fall even further to about 3.1%. That's perhaps the lowest that we have seen on record in this new CPI series. Now, there are two factors why core inflation is so low. One is a very favorable base effect, which was generally larger for most part of the recent quarters that we've seen. And the second is the kind of ebbing of commodity price shock we witnessed in the last few quarters also contributed to lower input costs for producers, and therefore a lower imperative for them to pass on these costs to the consumer. That's from the producer's side, the supply side. We have also seen a decent manufacturing recovery, which probably has aided aggregate supply in the economy at a time when we know that private consumption is not growing very fast. So I think the broader demand-supply balance for all commodities except food is largely in favor of lower inflation, which is generally reflected in core inflation trends.
All right, Dheeraj, also let's talk about rural growth as well. We've seen FMCG come out with they're saying that there are green shoots there in terms of rural consumption. There was a survey as well that kind of said that they're seeing rural demand surpassing urban as well. What are your views on this? I think this similar question was raised to the RBI governor also during the MPC meet. We didn't see a clear answer from him. But how are you seeing this kind of play out in the next year?
Look, in FY25, rural has the benefit of a very low base from FY24. We know that agricultural output was very weak in FY24 because of vagaries of weather. Now, if monsoon is decent, at least normal, and decently distributed across region and across time, there would be, of course, significant revival in rural output in the sense agricultural output could increase. At the same time, we're not expecting any significant slowdown in the construction sector, especially from the public capex angle. Therefore, the alternative sources of employment in the rural economy could also very much remain while agriculture comes back on its feet. So I do think there is a rural revival in the offing. Various indicators such as FMCG sales, consumer non-durable production, and consumption of various items that are specific to rural India are showing these green shoots, which are quite encouraging.
Right. Coming back to fiscal consolidation that you spoke about in your first answer, I guess we saw RBI surplus coming into the government. Do you see the government meeting that target of fiscal deficit?
I do think so. In the full budget that is due to be presented in July, we think the government will retain the fiscal deficit target at 5.1% of GDP. Now, the question is, what would the government do with that extra money that they've got from the Reserve Bank of India? And I think especially on the back of recent election results, it seems that the populations are concerned about deeper economic issues, which may warrant some higher spending on social sector accounts, and the government may feel the need to do so. So I do think while adhering to the fiscal deficit target of 5.1% of GDP and not sacrificing capex outlays, that additional funds that the government has got from the Reserve Bank of India could be utilized to spruce up some social sector spending, which may actually do well for growth in the near term.
All right. Lastly, Dheeraj, the final question. We have the Fed decision coming up today. What are your expectations from the FOMC meet, especially towards in terms of commentary, in terms of rate cuts? How are you taking that?
Look, I think everybody's watching that with a bated breath. I think one thing to look forward to the FOMC decision would be the dot plot, which would give you a somewhat clearer indication of what the Fed is thinking of in terms of rate cut. Now, take a step back. The gyrations in the financial markets globally because of pricing and repricing of the Fed rate cut expectations have been behind volatility in the FX markets, most recently as of yesterday. So I think that the US CPI print along with the FOMC print tonight would probably mark a momentous day. And we hopefully should get somewhat clearer direction about where the Fed is heading in terms of its rate cuts and where the US inflation is heading in terms of its disinflation trajectory.
All right, point taken, Dheeraj. Thank you so much for joining us on the show today and for sharing your views with us.
Thank you.
Well, it's time to slip into a short break, but don't go anywhere. We have lots more lined up for you. Stay tuned. Welcome back. You're watching Market IQ. Now, TDP chief N. Chandrababu Naidu today took oath as minister for the fourth time, chief minister for the fourth time after his party scored a thumping win in the assembly polls held alongside the general elections. 24 members of his cabinet also took the oath alongside him. Prime Minister Narendra Modi, Home Minister Amit Shah and BJP Chief and Health Minister JP Nadda are attending the grand event on the outskirts of Vijayawada. My colleague from NDTV, Uma Sudhir, joins us now. Tell us more about it. Uma, what are Naidu's top 3 immediate tasks for the state?
So, grand star-studded swearing-in ceremony of Chandrababu Naidu as the Chief Minister for the fourth time. Chandrababu Naidu 4.0 is going to be different from the earlier 3 tenures or terms as Chief Minister. This time round, a historic mandate, as Naidu himself has called it, a historic mandate delivered by the people that has put a lot of responsibility on him. So, while he has got this mandate of almost 94% of the constituencies with the NDA, Chandrababu Naidu's verdict being even greater than what N.T. Ramarao got in 1994. So, for Chandrababu Naidu, he has also already prioritized what are going to be his focus areas. The first one, of course, will be Amaravati, the capital that he had dreamed for Andhra Pradesh after the bifurcation in 2014, and he would be hoping to be able to build it in the smallest possible time. At that time, of course, 50,000 crore rupees was slated as the cost of that project, and even though Prime Minister Modi was there there for the inauguration. The criticism was that the centre did not extend enough help. But what sources within the Telugu Desam have been telling us is that already 15,000 crore rupees has been spent. A huge amount of the cost is actually spread over years, and they would hope that the investors and others who had evinced interest earlier would come back to Andhra Pradesh, given the kind of mandate that Chandrababu Naidu has won, and he would be hoping that he can get help from the centre as well, because not just Chandrababu Naidu, whether it's an Amit Shah or Mr. Narendra Modi, the Prime Minister and the Home Minister, both have in fact said that the Amravati will be built as the capital of Andhra Pradesh. The second big priority is going to be the Polavaram project, for which they want to get national project status and to be able to complete that project, which will irrigate 7 lakh hectares of land in Andhra Pradesh. And that is a big priority to be able to improve the economic well-being of the farmers. And that's a huge belt, in fact, which is a fertile belt of not just of the state, but the country itself. It's called the food belt, in fact, because it's the place where multiple crops can grow in that area. The third important priority actually is going to be welfare. Welfare that Chandrababu Naidu has promised almost equal to Jagan Mohan Reddy. He has spoken about farmers' benefits, women who are sending their children to school. They will be getting monetary benefit, just like Amavodi scheme of Jagan Mohan Reddy. In everything, in fact, he has pitched it one level higher and in fact promised a huge welfare package. He has also promised at the same time investment, industry and also jobs. 20 lakh jobs is what they have promised. They've spoken about the guarantees, and they would be hoping in fact that the kind of a mandate that they've got will inspire confidence among investors as well, not just the corporates but also other kind of more lesser known perhaps money sources that can be used in order to be able to fund the plans that Chandrababu Naidu has for Andhra Pradesh. All this, of course, while he is balancing very delicately the political equations within the state. He has been very careful to ensure that Pawan Kalyan is given equal kind of a stature. He is probably going to be made his deputy as well. And while Nara Lokesh is number 2 in the TDP, Pawan Kalyan, for now at least, is safer for Chandrababu Naidu also to have him within the government, even though Pawan Kalyan and the TDP as as parties that would want to grow, Pawan Kalyan and the Janasena would want to grow, and the TDP, for the TDP, it's better to keep Pawan Kalyan on the ruling side itself instead of trying to occupy that opposition space, which is in fact taken up by the YSRCP with its lone 11 MLAs.
Thank you so much, Uma, for being so comprehensive with us. Let's shift focus to the auto sector now. EVs have been the talk of the town today after Ola Electric got SEBI's approval for its 7,250 crore IPO. Now, incidentally, FADA came up with EV sale numbers for the month of May. Interestingly, EV three-wheelers overshadowed two-wheeler sales. My colleague Tushar joins in with a report on that.
Electric three-wheeler sales overshadowed those of electric two-wheelers in the month of May, according to the FADA data that was released recently. So electric three-wheeler sales have grown by more than 20% year-on-year, while those of electric two-wheelers have declined by more than a fourth over the same time period. So why is this happening? FADA says is due to the lack of the FAME 2 subsidy, which was reduced in June last year and was done away with completely at the end of the previous fiscal. So there was one more scheme that was brought in, the Electric Mobility Promotion Scheme, but that is also only for 4 months. Now, FADA is batting for the new government to launch a new FAME scheme called the FAME 3 scheme. According to Manish Raj Singhania, the president of FADA, the automotive industry is eagerly looking forward to the announcement of FAME 3 by the newly formed government. We believe that will provide the necessary boost to EV sales and help increase the market share significantly. Electric cars saw a marginal decline, but there was a small increase in commercial vehicles, electric commercial vehicle sales as well.
Thank you so much, Tushar, for that. Now, before we wrap this edition of Market IQ, Union Minister Hardeep Singh Puri said India will target 20% ethanol blending by 2025, which served as a factor for the uptick in sugar stocks yesterday. My colleague Mathew caught up with ISMA's Deepak Balani on the government's policies for the sugar industry. Listen in.
I think we believe that the government, first of all, will continue the proactive policies for the sugar industry. As far as our expectations are concerned, I think with Modi 3.0, the government 3.0, immediate actions of the government should be for the long-term stability of the industry. You know that the government made a policy shift in December 23 and reduced the juice and B-heavy based ethanol production. So it was reduced to 17 lakh tons diversion in 23-24 from 38 lakh tons the previous year. So this curtailed the juice and B-heavy production, which resulted in the underutilization of the installed capacity, which we all know led to huge losses to the industry. I think this has resulted in a substantial increase in sugar inventory, which would, I think, would be around 90 lakh tons on 1st of October this year. So therefore, I think, first of all, these policies should be re-implemented to manage the rising sugar inventories and also support the industry's stability. So I believe the first and the foremost priority of the government should be on continuation of the ethanol blending program by allowing juice and B-heavy for the ethanol production. Second, but equal priority is also the revision of MSP of sugar and its alignment with the FRP of sugarcane. In earlier years, depending on the FRP, MSP was raised to ensure viability of the millers to pay the cane prices to the farmers in a timely manner. So it was always that whenever there was an increase in FRP, government increased the MSP. But since 2018 and 19, they have not increased the MSP. So I think that needs to be corrected, and the MSP needs to be revised vis-a-vis the increased FRP of sugarcane. Third is a very important factor, that the revision of ethanol pricing. Any time when the FRP of sugarcane was increased, B-heavy, C-heavy and juice-based ethanol prices were corrected accordingly. I think we would request government and we expect them to correct the ethanol prices for the juice and B-heavy for 23-24 and for juice, B-heavy and C-heavy for 24-25 in line with the increase in FRP of sugarcane. As far as the 20% ethanol blending target, I think we must congratulate the government. I think we are on the right track. As ISMA, I think we are very confident that the ethanol program is on track. Going forward, things look good and the sugar sector will achieve its target. I think currently we have our capacity specifically in the sugar sector of around 850 crore litre. And as per the Niti Aayog report, requirement of 20% blending will require approximately 1,000 crore litre of ethanol. So I think they have projected, Niti Aayog, as per their roadmap, they had projected a requirement from sugar industry to be around 550 crore litre. So I think we believe that with sufficient feedstock availability, we as a sugar industry will be able to cater to the required quantity as per targets. So for this, we basically have also submitted an action plan to the government for long-term sustainability of sugarcane production, which will help negate fluctuation in production we have seen because of the uncertainties of weather. So we are confident that the sugar industry will be able to supply almost 55% of the total ethanol for 20% blending. And I believe the government is very keen to work on our proposal, and we hope that they will come out with a national mission on sugarcane in near future.
That's really great. My another query on this is that there is, on one hand, where so much of thrust is there on meeting the ethanol blending target. On the other hand, ISMA is also seeking the government approval for 2 million ton of sugar exports in the marketing year. So how is it likely now with the change in the government is same, but definitely with not as clear majority. What do you think? Is it likely for the government to approve this?
See, we had already requested for an approval of 2 million tons of sugar exports, and that was based on facts and figures. So if we go back in the last season, the opening stock, for example, in this 23-24, the opening stock was around 55.65 lakh tons. And we had the production of 320 lakh tons this year. And with domestic consumption of around 285 lakh tons, I think on 30th of September this year, we will have a closing stock of around 90 lakh tons. I think we believe that we have enough supplies to meet the domestic demand of sugar and also export at least 2 million tons of sugar this year. And given that the fact that we have an improved pre-monsoon rainfall, we have the forecast indicating above normal monsoon conditions, and the sugar production for the 24-25 is expected to be moderate. I think it will ultimately, we will have a substantially higher closing stock going forward. So I believe this export allowance would not only ensure a comfortable stock for domestic consumption and also sustain the ethanol blending program, I believe it will also contribute to maintaining the financial liquidity of sugar mills and enabling them to pay timely payments to the farmers. I think with these, we expect the government to take a decision on export soon.
Hello and welcome to NDTV Profit. You are watching the Mutual Fund Show. I am Muralidhar Swaminathan, your host, and joining me on the show is Vishal Jain, CEO, Zerodha Fund House. Vishal, welcome to the show.
Hi Murali, good afternoon. Thanks for having me on your show.
Good afternoon, Vishal. These days we have an interesting combination of offering coming from mutual fund houses, and but you are offering the investors something very simple and easy to understand and invest in passive funds. Can you take us through why are you sticking only to passive funds?
So Murali, let me step back and explain what we are trying to achieve as an AMC. Right. Our vision is to increase penetration and participation of individual investors in the Indian capital market through the use of mutual fund products. Penetration at this point of time is still limited to about 4.5 crore investors in a population of about 140 crores, which is just about 3% of the Indian population. And to enable this vision of increasing participation, we want to equip investors with products that are easy to understand, transparent, and affordable. And passive products, index-based products exhibit these qualities in the most straightforward manner. And most of all this scalable, right? And therefore, our product bouquet will consist of simple exposures to index funds and ETFs. I mean, if you look at our product bouquet, we started off in November with an index fund and a passive ELSS scheme based on the Nifty Large Mid-Cap 250 Index, a 50-50 exposure across large caps and mid caps. So on one side, investors got the stability of large caps, and on the other side, they got the growth kicker that comes from mid caps, right? And so those investors who are looking at investing in the Indian growth story could invest in this product in perpetuity without the need for any other product, and that was the objective with which we launched that product. The third product which we launched and which in fact has become a hero product for us is India's first growth liquid ETF. Again, an innovative product born from our dogged yearning and belief to make investment products easier for investors, right? This liquid ETF, liquid case, made trackability easier for investors. And one of the big things is it brought the price down from 1,000 rupees, which are the existing liquid ETFs, to 100 rupees, and therefore made it more accessible to retail investors. In a short span of time, that product has become 1,400 crores across 75,000 investors. We then went on to launch the Zerodha Gold ETF, and it's one of the cheapest gold ETFs in the market in terms of TER. Our current offering, which is the Zerodha Nifty Large Mid-Cap 100 ETF and the Zerodha Nifty Mid-Cap 150 ETF. Again, they're targeted equity exposures to different market segments and can be used by investors as basic building blocks for investors. With this bouquet of products, we would have offerings across equity, debt, and commodity. And therefore, for those investors who are a bit more savvy, it helps them, build individual asset allocation portfolios based on their individual needs. For others, we will look at launching a few ready-made solutions, say in the fund-of-fund format. And therefore, when an investor looks at, say, a Zerodha Fund House, he would have the ability to build his own portfolio and also be able to pick certain ready-made solutions from the products that we'll have.
Right. I will ask you a very simple basic question. It looked like an obvious one. There are so many passive funds. There are so many fund houses who offer a variety of both active and passive and ETF as well. But why should one come to Zerodha?
Again, I think it's different fund houses have different ways of selling it. I think what we are trying to do is we're trying to focus more on the retail market. We're trying to build products which are very retail centric. And it depends on each investor in that sense. If you look at, as I said, if you look at the kind of product that we're building, I gave you a simple example of a liquid case, which is a liquid ETF, again, a product which is 2 decades old. In a short span, because of the fact that we've built products which are very retail centric, we've got huge traction coming in from there. So I guess it's a fact that we're building products and the name, brings trust with it.
Right. Okay, so explain to our viewers the difference between a passive fund and an ETF, because both are very simple to use, no-brainers. There is no fund manager behind this. The market takes care of your investments. How does one differentiate between a passive and an ETF fund?
So both ETFs are passive and index funds are passive as well. It's just that they're two different structures. So if you look at the mutual fund market, or if you look at mutual funds over the last 50, 60 years, there are only three structures in the market, right? When mutual funds started off, they started off with something called as a close-ended structure, which in a sense is not very popular in today's day and age. Then you had open-ended schemes, which now are the mainstay of most mutual fund products in the market globally. The third structure which has come about is an exchange traded fund, again, a passive product, but products which you can price on a real-time basis. So I would say that whether it's an index fund or it's an ETF, the benefits of passive investing is what somebody should look at, which is the simplicity, the transparency, and the